Most people believed they would notice if something truly important was taken from them. A paycheck deduction, a new tax, a fee quietly added to a bill. Loss, we assume, announces itself. But the most effective thefts in history were never loud. They were procedural. They were technical. They were explained away by experts using language that sounded reassuring, complex, and inevitable. What if the largest financial loss of your lifetime didn't happen through taxes at all? What if it happened quietly, legally, and invisibly, while you were told it was for your own protection? Pause for a moment and consider this. In early 2020, the life you were building had a certain internal logic. Prices made sense. Saving felt purposeful. Working harder meant moving forward. Fast forward just a few years. You earn more dollars, yet afford less life. You save more, yet fall further behind. You do everything right, and still lose ground. This contradiction is not personal failure. It is systemic design. And once you see it clearly, it becomes impossible to unsee. Here is the uncomfortable truth. Between 2020 and 2022, the Federal Reserve created approximately $4.5 trillion out of nothing. Not from taxes, not from productivity, not from growth, from keystrokes. That single decision quietly reduced the purchasing power of the US dollar by roughly 30% in real-world terms. If that number feels abstract, that's intentional. So let's make it concrete. A home that cost $300,000 before the pandemic now costs $420,000 to $450,000 in many parts of the country. That is not appreciation driven by innovation or scarcity. That is dilution. Your dollars did not disappear. They were debased. And the people who received the new money first, banks, asset owners, financial institutions, captured the upside before prices adjusted. Everyone else paid the bill. This mechanism has a name. It is called inflation. But that word is far too gentle for what actually occurred. Because inflation is not neutral. It does not affect everyone equally. It is a transfer mechanism, one that quietly moves wealth from people who work for money to people who already own assets. And it is the most politically efficient extraction system ever invented. No vote required, no public debate, no visible outrage, just a gradual erosion of purchasing power that most people struggle to explain, even as they feel it every day. Now here is where the story becomes deeply unsettling. This was not an accident. It was not a mistake. And it was not unforeseen. The architects of monetary policy understood exactly what would happen when they expanded the money supply by this magnitude in such a short period of time. They accepted the consequences, because those consequences were distributed unevenly. To understand how this happened, we need to step back to a moment of fear. March 2020. The economy shut down. Businesses closed overnight. Supply chains froze. Markets panicked. The stock market fell more than 30% in a matter of weeks. And at that moment, the Federal Reserve faced a choice. They could allow markets to correct, allow over-leveraged companies to fail, allow asset prices to reset, allow a painful but cleansing recession. Or they could intervene aggressively, historically, without precedent. They chose intervention. On March 15, 2020, the Federal Reserve cut interest rates to 0. And more importantly, they announced unlimited quantitative easing. Unlimited. That single word should have alarmed every citizen in the country. Quantitative easing sounds technical, but the mechanism is brutally simple. The Federal Reserve creates new dollars electronically and uses them to buy government bonds and mortgage-backed securities from banks. The banks receive freshly created money. The Fed receives financial assets. No productivity required. No savings involved. No democratic approval. Before the 2008 financial crisis, the Fed's balance sheet was under $1 trillion. By the start of 2020, after years of crisis-driven interventions, it had grown to about $4 trillion. Then came COVID. In just 2 years, the Fed added another $4.5 trillion. More money created in 24 months than in the entire previous century. This matters for one simple reason. Money is not just a unit of exchange. It is a claim on real goods, real labor, and real resources. When you dramatically increase the number of claims without increasing the underlying reality, every existing claim becomes weaker. This is not ideology. It is arithmetic. But here's the detail most people miss. That $4.5 trillion did not go to you. It did not show up in your savings account. It did not raise your wage. It went first to the financial system, to banks, to institutions, to asset markets. And this is where the Cantillon effect comes into play, a principle first identified centuries ago, long before modern central banking. When new money enters an economy, the people closest to its source benefit the most. They spend it before prices rise. Everyone else receives the money later, after prices have already adjusted upward. In modern America, banks and financial institutions sit closest to the source of money creation. They receive liquidity first. They deploy it immediately. And they deploy it into assets, stocks, real estate, corporate bonds. That is why, even as millions of Americans lost jobs in 2020, the stock market recovered at record speed. By late 2021, the S&P 500 had nearly doubled from its pandemic lows. Home prices exploded. Asset owners became dramatically wealthier, not because they produced more, but because the monetary system lifted them upward. Meanwhile, wages barely moved. If you were paid in assets, you thrived. If you were paid in wages, you fell behind. Let's make this painfully clear with a real-world scenario. Imagine you were 28 years old in 2019. You were working, saving, trying to do things the responsible way. You had managed to save $30,000 toward a down payment on a $300,000 home. You were halfway there. Another couple of years of discipline, and you would make it. Then, the Fed printed trillions. By 2022, that same home cost $420,000. Your savings grew to $45,000. But the required down payment jumped to $84,000. You didn't fall behind because you were irresponsible. You fell behind because the finish line moved faster than you could run. This is what inflation theft looks like. Your dollars still exist. They just buy less life. And now, Here is the psychological hook that keeps people trapped. Inflation is framed as a temporary inconvenience, a phase, a disruption, something that will be brought under control. But prices do not go back down. They stabilize at higher levels. When inflation falls, it means the rate of increase slows, not that costs return to what they were. That $2,000 rent doesn't go back to $1,500. That grocery bill doesn't rewind. Your purchasing power loss is permanent. And yet, because there was no single moment of shock, no obvious villain, no explicit tax hike, most people internalize the blame. They think they miscalculated, worked too slowly, saved too cautiously. This is the most dangerous outcome of all, because a system that convinces people to blame themselves for structural extraction becomes self-sustaining. In the next part, we're going to expose exactly who benefited, how the wealth transfer worked in precise numbers, and why this mechanism consistently enriches the same group every single time it's deployed. And once you see that pattern, you'll understand why this will happen again. To understand who truly benefited from the creation of $4.5 trillion, we have to abandon the comforting idea that inflation affects everyone equally. It doesn't. Inflation has a direction. It moves outward from the point of creation. And the closer you are to that point, the more you gain. The further you are, the more you lose. This is not theory. It is observable, repeatable, and historically consistent. When the Federal Reserve created trillions of dollars, it did not mail checks to households first. It injected liquidity into the financial system. Banks received reserves. Institutions gained access to near-zero-cost capital. Markets were flooded with money looking for yield. This is where the story splits into two Americas, one that owns assets and one that lives on income. Let's look at what happened to assets between 2020 and 2022. The S&P 500 rose more than 90% from its pandemic lows. Corporate bond prices surged as yields collapsed. Real estate prices climbed at the fastest pace in modern U.S. history. In many metro areas, home prices rose 40 to 60% in just 2 years. This was not organic growth. Population didn't surge. Productivity didn't double. What surged was money. When trillions of new dollars chase a limited supply of assets, prices must rise. This is not capitalism misbehaving. It is monetary expansion doing exactly what it always does. Now compare that to wages. According to the Bureau of Labor Statistics, real wages declined sharply during this same period. Nominal paychecks increased slightly, but after adjusting for inflation, most workers became poorer. This is the defining feature of inflation theft. Your paycheck may grow, but your purchasing power shrinks faster. You feel like you're moving, but you're actually sliding backward. Meanwhile, asset owners experience the opposite. Their wealth inflated faster than prices. They could borrow cheaply against appreciating assets. They could refinance, extract equity, and reinvest. Debt became lighter in real terms. This is why inflation is not merely an economic side effect. It is a wealth transfer mechanism, from labor to capital, from savers to borrowers, from the disciplined to the leveraged. And this is where the middle class suffers the most. The middle class sits in the worst possible position during inflation. It holds cash and fixed income savings. It relies on wages. It aspires to asset ownership, but often doesn't yet have enough. So when inflation hits, it is squeezed from both sides. Savings lose value. Assets move further out of reach. Now let's talk about the role of debt. Debt is often framed as irresponsible, but in an inflationary system, debt changes character. Fixed-rate debt becomes a weapon. If you borrowed $300,000 in 2020 at a 3% mortgage rate, inflation worked for you. Your monthly payment stayed the same, but the dollars you used to repay it became less valuable every year. Inflation quietly subsidized your debt. Now flip that perspective. If you didn't already own assets or didn't feel comfortable taking on leverage, you missed the ride. Not because you were wrong, but because the rules changed. This is the cruel irony of inflation theft. It rewards those who are already positioned correctly and punishes those who are cautious, patient, and responsible. Now let's address a question many people ask instinctively. Didn't stimulus checks help regular people? Yes, briefly. Direct payments provided short-term relief, but they did not offset long-term dilution. Most stimulus checks were spent quickly on necessities: rent, food, utilities. They did not create lasting assets. Meanwhile, the trillions injected into financial markets permanently repriced wealth. This is the difference between consumption support and asset inflation. One fades, the other compounds. This is why the top 10% of households saw their net worth increase dramatically after 2020, while the bottom half saw little improvement or outright decline in real terms. Again, not conspiracy, structure. Now let's examine the Federal Reserve's defense. The Fed argues that its actions prevented a deeper recession, that without intervention, unemployment would have soared and markets would have collapsed. This argument is partially true, but it hides a deeper truth. Intervention did not eliminate pain. It redistributed it. Instead of immediate market correction, we received long-term purchasing power erosion. Instead of asset deflation, we received cost of living inflation. Instead of visible collapse, we received invisible extraction. This trade-off was never presented honestly to the public, because if it had been, many would have objected. Now here is the most critical point. Inflation theft is not a one-time event. It creates precedent. Once markets and governments learn that massive monetary expansion is politically survivable, it becomes the default response to every future crisis. This is why inflation is so dangerous. It teaches the system the wrong lesson. Every crisis justifies the next intervention. Every intervention raises the baseline. This is how extraordinary measures become normal. Before 2008, quantitative easing was unthinkable. After 2008, it was exceptional. After 2020, it became expected. And expectations shape policy. Now consider what this means going forward. The US government carries more than $36 trillion in debt. Servicing that debt at high interest rates is impossible without fiscal collapse. This creates enormous pressure on the Federal Reserve to suppress rates. Suppressed rates encourage more borrowing. More borrowing demands more money creation. This is not speculation. It is arithmetic. And it leads to one conclusion. Inflation is no longer an emergency response. It is a structural feature, which means the theft is ongoing, quiet, legal, relentless. In the next part, we will explore how this changes behavior at every level of society, why people feel more anxious, more aggressive, and more disconnected, even when unemployment is low and markets appear strong. Because inflation doesn't just steal money, it steals stability. Inflation does not simply rearrange balance sheets, it rearranges psychology. This is the part that economists rarely model and politicians almost never acknowledge. Because once inflation changes how people think, it becomes far more difficult to reverse than any policy mistake. The first psychological fracture inflation creates is the loss of trust in effort. In a stable monetary system, effort and outcome are linked. You work, you save, you improve your position over time. That relationship is the moral foundation of the middle class. Inflation quietly breaks it. When people discover that working harder does not protect purchasing power, motivation changes. Not immediately. At first, people double down. They work longer hours, they take side jobs, they hustle. But when those extra efforts still fail to close the gap, something darker appears. Disillusionment. This is not laziness, it is recalibration. People stop believing that the system rewards discipline, and once that belief erodes, behavior shifts in ways that statistics can't fully capture. Savings rates decline. Short-term thinking increases. Risk-taking becomes normalized. This is not because people become reckless. It's because playing it safe no longer feels safe. Inflation turns patience into a liability. The second psychological effect is the distortion of time. In healthy systems, time is an ally. Delaying gratification is rewarded. In inflationary systems, time becomes an adversary. Every dollar held loses value. Every delay costs purchasing power. So people accelerate decisions. They buy sooner. They borrow sooner. They invest sooner, often without fully understanding the risks. This is why inflationary periods are often accompanied by bubbles, not because people are irrational, but because standing still guarantees loss. When risk becomes mandatory, judgment deteriorates. The third effect is emotional exhaustion. Inflation creates constant low-grade stress, not panic, pressure. Every decision feels heavier. Grocery shopping requires calculation. Rent renewals provoke anxiety. Long-term planning feels fragile. This pressure accumulates. It doesn't explode, it drains. And drained people are easier to mislead, polarize, and manipulate. This is why inflation is so socially corrosive. It doesn't provoke unity. It fractures attention. Now let's talk about social consequences. When inflation persists, it reshapes class dynamics. The gap between asset owners and wage earners widens visibly. Not because asset owners are smarter, but because the system rewards position, not effort. This creates resentment, but not always toward the right target. Instead of questioning monetary structure, frustration is often redirected toward employers, toward immigrants, toward politics, toward culture wars. Inflation creates anger without clarity, and anger without clarity is easily exploited. This is one of the reasons inflation precedes periods of political instability throughout history. Not because people suddenly become extreme, but because they feel betrayed and cannot name the betrayer. Now consider trust in institutions. Central banks insist inflation is under control. Governments emphasize strong employment numbers. Markets celebrate growth. Yet lived experience tells a different story. This mismatch erodes credibility. Not instantly, gradually. People stop listening closely. They stop believing fully. They comply outwardly while disengaging inwardly. This is how legitimacy decays without collapse. The most dangerous outcome is not outrage. It is apathy. A society that becomes apathetic is a society that no longer defends its future. Now here's the paradox. Inflation doesn't make everyone poorer immediately. Some people thrive. Those with assets, those with leverage, those with access to capital. This creates confusion. If the system were truly broken, wouldn't everyone be suffering? But inflation doesn't work that way. It creates winners and losers simultaneously. And because the winners are often visible and vocal, the suffering of the losers feels personal rather than systemic. People blame themselves. They think they made bad choices. They assume others are simply better at the game. This internalized failure is one of inflation's most insidious effects. It isolates people psychologically. Now let's bring this back to the Federal Reserve. The Fed's mandate includes price stability. But in practice, it balances inflation against market stability and employment. When forced to choose, it consistently prioritizes preventing asset collapse. Why? Because asset collapse is immediate and visible. Inflation is slow and abstract. This creates a bias. Markets are rescued, people are adjusted, and adjustment becomes a euphemism for erosion. This is why inflation persists even when officials acknowledge it, because stopping it would require allowing asset prices to fall sharply. And that would reveal how inflated the system truly is. So inflation continues, managed, contained rhetorically, but never eliminated. At this stage, inflation becomes embedded in expectations. Businesses raise prices preemptively. Workers demand higher wages. Landlords increase rents automatically. The system internalizes inflation as normal. Once this happens, reversing it becomes exponentially harder. Not because tools don't exist, but because the social tolerance for pain disappears. This is why inflation is often described as a one-way door. You can slow it, but going back requires sacrifice few are willing to accept. Now ask yourself an honest question. Does any major political force appear willing to accept that sacrifice? Cut spending dramatically, allow markets to reset, permit short-term pain for long-term stability? The answer is obvious, which means inflation is not ending. It is evolving. This brings us to the most important realization. The danger is not runaway hyperinflation. The danger is permanent erosion. A slow decline in purchasing power that reshapes life without triggering alarms. This is far more damaging than a sudden crisis. because it gives people no clear moment to resist, no single event to rally around. Just a long, exhausting adjustment. In the final part, we will confront the hardest question of all. If inflation theft is structural, ongoing, and politically unavoidable, what does intelligent response actually look like? Not panic, not speculation, not escapism, but clarity. Because understanding does not eliminate inflation, but it prevents you from being its passive victim. At this point, the most uncomfortable question can no longer be avoided. If inflation has quietly transferred trillions in wealth, reshaped behavior, and eroded trust, why does the system continue to rely on it? The answer is not incompetence. It is constraint. Modern governments are no longer free to choose stability without consequence. They are trapped by obligations created under assumptions that no longer hold. Promises made when money was scarce now exist in a world where money is abundant, but value is not. This is the contradiction at the heart of the system. Social programs, pensions, debt servicing, defense, healthcare, all depend on continuous funding. Cutting them would trigger immediate political crisis. Raising taxes enough to cover them would collapse economic activity. Default would destroy credibility overnight. Inflation remains the only option that spreads pain slowly enough to be tolerated. This is why inflation is not a failure of policy. It is the end point of policy. Not chosen explicitly, arrived at implicitly. And once reached, it becomes self-reinforcing. Every year of inflation raises nominal costs. Higher costs demand higher spending. Higher spending demands more borrowing. More borrowing demands more money creation. This loop is now embedded. Breaking it would require a level of coordination, sacrifice, and honesty no modern democracy has demonstrated. This does not mean collapse is inevitable. It means normalization of erosion. Life continues. Institutions function. Markets operate. But the internal logic has changed. The old rules no longer apply, even if they are still taught. This is where intelligent response begins, not with fear, with realism. The first step is recognizing that money no longer serves as a reliable store of value. It is a medium of exchange, a tool for movement. Holding it long-term guarantees loss. This changes how one thinks about saving. Saving becomes transitional, not terminal. Money is held briefly, then converted into something that adapts. The second step is understanding that nominal gains are deceptive. A higher salary means nothing if purchasing power falls faster. A rising portfolio means little if it cannot secure the same standard of living. This reframes success. From accumulation to resilience. The third step is accepting that debt has inverted its moral character. In stable systems, debt is dangerous. In inflationary systems, fixed-rate debt becomes insulation. This does not mean reckless borrowing. It means understanding that inflation punishes those who avoid leverage entirely, while rewarding those who manage it intelligently. This is uncomfortable, but history is clear. The people who survive inflation best are not the most cautious. They are the most adaptive. Now here is the most important distinction of all. Adaptation does not mean speculation. It does not mean chasing trends. It does not mean abandoning discipline. It means aligning behavior with structure, understanding where inflation flows, understanding what reprices, understanding what erodes. This is why education matters more than prediction. You do not need to know what inflation will be next year. You need to know that it will continue. And that knowledge changes decisions. The tragedy of inflation theft is not the loss itself. It is the silence surrounding it. People feel poorer. They feel anxious. They feel unstable. But they are rarely given an honest explanation. So they internalize blame. They assume failure. This is the final extraction, not just of money, but of confidence. Understanding reverses that. It restores agency. Not control over the system, but clarity within it. This is not cynicism. It is maturity. Every complex system eventually reveals its limits. The current monetary system is doing so now, quietly, persistently, without drama. Those who expect collapse will wait forever. Those who expect rescue will be disappointed. Those who understand structure will adapt. This is the dividing line, and it is already forming. If you've stayed with this analysis until the end, it suggests you sensed the gap between official narratives and lived experience. That instinct is valuable. It deserves cultivation. If this perspective added clarity rather than fear, supporting work that prioritizes understanding over outrage helps keep these conversations alive. A thoughtful subscription signals that depth still matters. A simple acknowledgement helps this reach others who feel the same unease but lack the language for it. And if there is one person you trust enough to think alongside, not argue with, sharing this may open a conversation worth having. If you choose to leave a comment, let it reflect reflection, not reaction. Those are the responses that shape better work. Thank you for watching to the end. In an age of noise, attention is still the rarest form of respect.